In 17 months, a company went from Super Bowl ad to bankrupt. Their mascot? A sock puppet. Their peak value, $300 million. Their final sale price? The sock puppet sold for over $100,000. The company was worth less than its mascot. But they weren't alone. Between 2000 and 2002, the Nasdaq lost 78% of its value. $5 trillion in wealth, gone. And the internet, the technology that was supposed to change everything, almost took the entire economy with it. Like Finny says, when the mascot is worth more than the company, you're not investing, you're collecting stuffed animals. Welcome to Finny Chronicles, where history meets money, power meets consequence, and every story is a warning somebody ignored. August 1995, a company called Netscape goes public. What does Netscape do? It makes a web browser, the piece of software that lets you look at websites. They priced the IPO at $28. By afternoon, the stock touches $75. Mark Andreessen, the 24-year-old co-founder, is worth $58 million. He made more money between breakfast and dinner than most Americans earn in a lifetime. The message is clear. The internet is the future, and the future is worth anything you'll pay for it. Like Finny says, Netscape didn't just launch a browser. It launched 1,000 bad business plans. What follows is the greatest gold rush since California in 1849. Venture capital pours into anything with .com in the name. The business model is simple. Get users, grow fast, worry about profit later. San Francisco, 1999. Meet Sarah, 28, stable marketing job at a Fortune 500. Boring, safe. She quits to join a startup that delivers groceries. Her mother thinks she's insane. Sarah thinks she's about to be rich. Her starting salary, $80,000, but the real compensation is stock options. If the company goes public and the stock goes up, those options could be worth millions. Sarah's already imagining early retirement. Everyone is. Sarah just bet her entire future on stock options. In 3 years, she'll find out if that was genius or disaster. If you want to see how this ends and how to spot the same pattern today, keep watching. And if stories like this matter to you, subscribe. Back to 1999. Let's look at what's being funded. Pets.com, selling pet supplies online. Problem? A bag of dog food weighs 40 pounds. Shipping it costs more than the food itself. They lose money on every sale. Their solution? Sell more. But they have a sock puppet. They spend $1.2 million on a Super Bowl ad. Webvan, Sarah's company, that spends $1 billion building automated warehouses before proving anyone wants the service. Sarah watches her options climb. $50,000, $100,000, $200,000 on paper. Cosmo.com promises to deliver anything in under an hour. Free shipping on orders as small as a candy bar. The drivers don't know yet that their last paycheck is coming. Like Finny says, stock options are the best thing ever invented, right up until you find out what happens when the stock goes to zero. Analysts explain, this is the new economy. Old rules don't apply. Profits are for dinosaurs. One analyst famously asks, if the internet is worth $1 trillion and Amazon gets 10% of it, isn't Amazon worth $100 billion? Like Finny says, in a bubble, the dumbest math sounds genius because arguing costs money and everyone's too busy counting theirs. They weren't stupid. They were human, and humans follow crowds. March 2000. The Nasdaq is approaching 5,000. It was at 1,000 5 years ago, a 400% gain. March 10th, 2000. The Nasdaq hits 5,048.62. All-time high. Time magazine calls it the new economy. Barron's asks what bubble. Day traders are quitting their jobs. Dentists are giving stock tips. Everyone's a genius, which is exactly what no one is. Tuesday morning, March 14th, 2000. Sarah checks her Webvan options. On paper, she's worth $2.3 million. She's 29 years old. She could buy her mother a house. On paper. She could retire at 35. On paper. She doesn't sell a single share. Why would she? The stock is going to $100. Everyone says so. Like Finny says, the moment everyone agrees something can't go down is usually right before it does. The warning signs are everywhere. Company insiders are selling millions in stock. Quietly. The Federal Reserve is raising interest rates. Money is getting expensive. For companies that burn through cash and need constant funding, this is a problem. Sarah doesn't notice. Nobody does. April 2000. The Nasdaq starts to slip. 5,000 becomes 4,500. Everyone says buy the dip. Sarah watches Webvan drop from $30 to $25. She tells herself it'll bounce back. April turns to May. 4,500 becomes 4,000. The companies that never made money, they're running out of cash. And suddenly, no one wants to give them more. Boo.com, a fashion website, burns through $188 million in 18 months. By May 2000, they're bankrupt. Sarah sees the headline. She tells herself Webvan is different. By November, Pets.com is liquidating. The sock puppet is sold at auction. Sarah watches Webvan collapse. March, $30. It'll recover. May, $15. This is temporary. July, $8. Maybe I should. September, $3. Silence. She still doesn't sell. She can't believe it's really happening. Like Finny says, hope is a beautiful thing. It's also how paper millionaires become actually broke. July 2001, Webvan shuts down. $1 billion in venture capital. 2,000 employees. Gone. Overnight. Sarah packs her desk. Her options are worthless. The $2.3 million was never real. She's 30 years old, starting over. The house she was going to buy her mother? Gone. eToys, dead. Cosmo, dead. Broadcast.com, acquired, then forgotten. Even the survivors are bleeding. Amazon, which actually survives, falls from $107 to $7. The Nasdaq falls from $5,000 to $4,000 to $3,000 to $2,000. In October 2002, it bottoms at $1,114, 78% decline from peak. Like Finny says, a 78% decline means you need a 350% gain just to break even. That's not a dip, that's a crater. Sarah, she went back to traditional marketing, rebuilt slowly, didn't trust stock options for years, but she learned. In 2003, she bought Amazon at $7. This time, she understood. Paper promises aren't real until they're real. She held it. Like Finny says, the bubble destroyed most people who played it, but it also built the foundation for everything that came next. Bubbles are fertilizer. Painful, expensive fertilizer. Now here's the uncomfortable part. 2020, 2021. Companies with no revenue, billion-dollar valuations, SPACs, electric vehicle startups, crypto tokens. Everyone's a genius again. Stock apps shooting confetti when you buy. This time, it's different. Old rules don't apply. It's about growth, not profits. By 2022, the bubble burst again. Crypto down 70%. Tech stocks crushed. Some companies down 80 to 90%. Same pattern, different names. Same math, same outcome. We can see it now because we're not in it. At the time, the smart people were just as wrong as everyone else. Like Finny says, every generation thinks they invented investing. They just reinvent the same mistakes with better graphics. The dot-com crash wasn't about technology being wrong. The internet did change everything, just not fast enough to save the people who bet too much too early. The real lesson? Price matters. Business models matter. Patience matters. Amazon at $107 in 2000 was a terrible buy. Amazon at $7 in 2001 was one of the best investments in history. Same company, different price, different outcome. The great companies do survive, but you have to be able to survive too. Sarah learned, don't bet your entire future on paper promises. Some things have to be real before you can count on them. The internet did change everything. The people who got rich from it, they're not the ones who bought at the peak. They're the ones who survived the crash. Like Finny says, the future always arrives, but the stock price doesn't wait. Being right isn't enough. Surviving long enough to be right, that's the whole game. One bubble, $5 trillion gone. And then from the wreckage, Amazon, Google, and the modern internet. If this story taught you something, hit subscribe. We drop videos like this every few days. Real stories about money, power, and the patterns that repeat. Sarah's story ended better than most, only because she learned from the crash and came back smarter. What would you have done? Sold at the peak, held through the fall, or walked away before it started? Drop a comment. I want to know. Next time, how the stock market dropped 22% in one day. Coming soon.